If you're starting a company, one of the biggest mistakes you can make is getting your founder stock wrong from day one. See, I'm a lawyer and I focus on helping startups. I'm also a 2X software founder myself, so I've been in your seat. And over the years, I've helped hundreds of founders properly structure their equity. So in this video, I'm gonna break down everything you need to know about issuing founder stock the right way, from the moment you incorporate to protecting yourself when investors come knocking. So let's dive in. First, you need to start with the right entity structure. So here's a mistake I see sometimes. I had a client who started as a Pennsylvania LLC, then converted to a Pennsylvania C corporation, then had to convert again to a Delaware C corporation when investors required it. 3 conversions, 3 sets of legal fees, all completely avoidable. Just start as a Delaware C Corp from day one and save yourself the headache. So why won't VCs touch LLCs? LLCs are pass-through entities, which create tax problems for VCs because VC funds have pension fund investors who can face tax issues when the VC fund invests in an LLC. And the issue that the pension funds face is known as unrelated business taxable income, UBTI. Investors also won't invest in LLCs because they're not as flexible in issuing equity and different classes and types of equity as C Corps. C Corps can issue different stock classes like common and preferred, and types of stock, NSOs, ISOs, restricted stock. So if you need help setting your Delaware C Corporation up the right way or getting your founder equity and legal documents investor ready, click the first link below to book a free consultation with me. Now back to the video. Issue your founder stock early. Timing matters more than most founders realize. When you first start your Delaware C Corporation, your shares are valued at basically zero. We're talking around 0.000001 per share. This incredibly low valuation is your golden window for tax savings. As you build value in your company, the share price increases. So if you wait too long to issue founder stock, you'll pay significantly more in taxes. And that's where the 83B election comes in. From the moment shares are issued, you have 30 days to file your 83B election with the IRS. This is not optional if you want to save money. It's an absolute must. Here's what the 83B does, is it shifts when taxes are applied. Without it, you get taxed when shares vest, which could be years later when they're worth significantly more. And here's why this matters. Let's say you have 1 million shares and you wait 4 years for them to vest. By that time, those shares might be worth $1 each at vesting. So let's say it's a 22% tax on $1 million. You'd owe $220K in taxes, but with an 83B filed at grant, you pay tax on virtually nothing because the value of the shares was low at grant. Now note, you still pay capital gains when you sell the stock, but at least you pay less tax because you avoid the vesting tax. But if you miss the 30-day window, there's no do-over. Then there's QSBS tax benefits for corporations. Qualified small business stock is one of the biggest tax benefits available to startup founders. If you hold your founder stock for 5 years, you can exclude up to $15 million in capital gains from federal taxes when you exit. That's potentially millions of dollars you get to keep instead of paying it to the IRS. But this only applies to C corporations and not LLCs. And the clock starts ticking from when you receive your shares, which is yet another reason to issue them early. Implementing vesting schedules. Standard vesting is 4 years, which means the company can repurchase your stock over that period of time. And the shares vest month over 48 months. You earn about 1/48 of your stock each month. There's typically a 1-year cliff, meaning you don't earn any stock until you've been at the company for 1 year. And after that first year, you get 25% of your stock all at once. Then the rest vests monthly over the remaining 36 months. And investors absolutely require vesting to protect their investment. And it usually is required for amounts of investment above 2 million. And investors will need to know you won't just walk away with all of your equity. Vesting ensures founders earn their ownership by staying committed to the company. You'll need vesting even if you're a solo founder. Investors will require this before they write a check. Let me tell you a horror story about what can happen without vesting. I had a client who issued 50% of his company to a co-founder with no vesting whatsoever. The founder who actually built the company dedicated every waking minute to their company, but the other founder barely showed up to meetings and put in almost no work. Eventually, the two founders got into a dispute. The founder who did all the work wanted the founder who was doing no work out, go figure. But here's the problem. The guy owned 50% of the company outright with no vesting protection. So the working founder had to get a valuation done, and the valuation came back at $500,000 for an early stage company. And that founder had to pay $250K out of his own pocket to buy out someone who did virtually no work. But this entire nightmare could have been avoided with a simple 4-year vesting schedule and a 1-year cliff. Now, investors may require revesting. Let's say you've been working on your startup for 4 years, all your stock is vested. You're feeling good. You own your shares outright. You're ready to raise a 10 to 15 million Series A round because your company is super successful, and then the Series A investors come in and say, we need you to revest your shares. This means applying a brand new 4-year vesting schedule to the shares that you already own. Now, why do investors do this? They want to ensure you're committed for the next 4 years, not just the past 4 years. They're about to put 10 to 15 million dollars into your company. They need to know you're not going to just take that money and leave. So this is actually pretty common at later stages, especially Series A and beyond. So don't be shocked if this happens to you. The good news is that these sorts of things are negotiable depending on your leverage and your track record. Making sure you get the stock issuance right. Start with 10 million authorized shares when you start your company. This is the industry standard number. When you incorporate, investors expect to see this number. It's what they're used to. Don't get creative here. Stick with what works. But why 10 million shares? Because it ensures that you have enough shares to issue without having to go back and amend your certificate of incorporation. It gives you flexibility to issue plenty of shares to everyone before having to go and amend your company's birth certificate, also known as your certificate of incorporation. And here's how to actually split equity between founders. Don't just split it 50-50 because you have two co-founders. Base the split on contribution and future commitment, not just who had the initial idea. Consider how many hours will each founder realistically put in, and what specific role will they play? Are they a technical co-founder, CEO, or business developer? And what's the median salary for their role in the market, and how do you value their equity accordingly? Now here's how dilution works. You'll issue 4 million shares split up between the initial founders, and how dilution works is ownership is calculated according to the authorized and issued shares. So when you start your company, you start with 10 million shares authorized. Then we typically give 4 million shares authorized and issued to the founders. So if there are two co-founders who each own 2 million shares each, then each founder will own 50% of the company. And as more shares are authorized and issued, then the founders get diluted. And by initially issuing 4 million of the authorized 10, there are more than enough shares for the company to issue without having to amend the certificate of incorporation to authorize more shares. There are 6 million shares remaining if you authorize and issue 4 million. Now, smart founders plan to issue 20% to future investors and then another 15% for employee stock option. And here's why planning matters. Planning ahead shows investors you're sophisticated and thinking long term. It also prevents nasty surprises when you need to hire key employees or raise your next round. You should always be modeling your cap table so you understand how dilution will impact you moving forward. Document everything with proper agreements. You absolutely cannot skip the initial founder agreements because investors will ask for them immediately when they start due diligence. Without proper documentation, investors simply won't invest. It's a deal breaker. These agreements protect both you and your co-founders from future disputes. They also prove to investors that you're running a professional operation. What you specifically need documented is restricted stock purchase agreements for all founders, vesting schedules clearly laid out in writing, no verbal agreements, IP assignments assignments for everyone. I'll speak on this more in a second. Some form of service agreement, like an employment offer letter or agreement or consulting agreement between each founder and the company. And here's what you need to know about stock options for employees. There are NSOs, non-qualified stock options. These are what you'll typically use once you have a stock option plan. ISOs, incentive stock options, which are another type of stock option with different tax treatment. And then RSPAs. And those are typically for founders and very early employees before the option plan exists. Once your option plan is established, usually at the seed stage where there's institutional investors, employees will get NSOs or ISOs. Securing your IP with IP assignment agreements. IP assignments are absolutely non-negotiable. Investors are investing in an asset, which is your company. They need to ensure that the company actually owns everything it claims to own. If your company doesn't own the IP, the company is basically worthless. IP assignment agreements ensure that anything anyone creates for the company legally belongs to the company. Now, who needs to sign these agreements? Every single founder from day one, no exceptions. Every employee, contractor, consultant, vendor, anyone who touches your product. Even if your grandma gave you an idea that you incorporated into your product, technically, she should sign one too. Anyone who's ever written a line of code, designed something, or contributed anything to your product or company needs to sign an IP assignment agreement. And what happens if you skip this step? It can completely derail your fundraise. I've seen acquirers refuse to close until every single IP assignment is signed, and someone who didn't sign can later come back and claim ownership of critical parts of your company. This is one of the most common issues I see in due diligence that could have easily been avoided from day one. Here's what happens at different funding stages. At angel and pre-seed rounds, these are typically raised using SAFE agreements. These are typically friends and family rounds, so your friends and family might invest without much formal documentation. But here's what you need to know. You still need proper securities filings, so don't skip this step. You'll need to file a Form D with the SEC within 15 days of taking investment. Yes, even for a SAFE. Here's what you need to know about seed rounds. 500,000 to 2 million still can be done with safes, but we also see priced equity rounds at the 2 million range. This is where investors will start asking serious questions about your cap table, your founder equity split, and your vesting. They'll want to see your IP assignments are in order, and this is usually where you'll need to create an employee stock option plan. And then Series A and beyond are priced equity rounds with term sheets and full due diligence. Investors will scrutinize everything: your incorporation documents, founder equity, IP assignments, option pool, contracts. They may require you to revest your shares to ensure you're committed going forward, as I talked about before, and they'll definitely require an option pool if you don't have one already. Now, the cost of getting any of this wrong isn't just a few $1,000s in legal fees to fix later. It's losing millions at exit or having your entire fundraise fall apart. I've seen all these scenarios play out, and they're completely avoidable. So if you're serious about protecting yourself and setting up your company for a successful fundraise or exit, the next step is simple. Click the first link in the description to book a free consultation with me. We'll review exactly where you are right now, identify gaps in your founder equity setup, and create a clear game plan to get you investor ready. So again, click the first link below to book your free consultation. And if you want to see how I helped a company raise 11 million in Series A funding and avoid some legal mistakes that would have been detrimental, then watch this video next.